After a massive downtrend for the last week, the market had a massive rebound on Thursday and Friday. Riz and I are going to talk about what in the world is behind this. Good evening, my fellow Riz Elite members, and of course, all of our subscribers on YouTube. Welcome to our weekly market recap webinar. My name is Chris. I'm part of Riz International, and I'm joined by the man himself, Riz. How you doing tonight, buddy?
Doing good, Chris. Yourself?
I can't complain. I definitely want to give special thanks to Riz for taking over webinar last week as I was celebrating the birth of my first child and we just got home from the hospital. I was in no condition to run a webinar, so I really appreciate that, buddy.
No, the pleasure is mine. Again, congratulations to you and Julia and on the little one. And I'm glad everything went well. And both the mom and the newborn are well. And again, my congrats. And as well, I'm sure people on YouTube who are watching this after probably news to them as well. So it's at least they know why. But yes, happy to step in there for you.
Really appreciate it. And of course, if you are watching us on YouTube, make sure you click that like and subscribe button. Let me know that, send your thanks for the, or your appreciation for the new child through that. Would really appreciate it if you could just hit that for us. And be part of the group here with Riz International. And so let's go ahead and take a look at the S&P 500. We had this run up here and we were kind of holding this uptrend for quite some time. And then we had a massive break last week where the market really started to break down. And then we kind of had a rebound on Thursday and Friday, and I didn't really think there was much going on. But Riz, can you kind of tell us what this massive rally is all about?
Yeah, I'll tell you very simply in a few words. Fed speaker, what was his name? Bostic. Last name Bostic. I don't know what his first name is. Not even worth knowing. Really went in there and just talked up the market, saying that maybe they're reaching peak rates. Maybe they might even do just a 25 basis point hike instead of what the market was actually pricing in, which was a potential 50 basis point hike. So he went and talked up the market, talked down rates. And you could see that massive spike, market really factoring that in. Although I feel like it's ridiculous that we have one individual who is frankly clueless in my eyes. But anyways, it doesn't really matter what I think. But what I can tell you is that's really the gist of it. Just that Fed speaker chatter was enough to bring in the buyers and really completely outmaneuver the selling that occurred in the prior week, and very much something that I did not anticipate. I did not expect that. I did not price that in, and no one could have, because no one knows what he's going to say, or anyone of these Fed speakers are going to say. And yeah, I'll be honest, I was, and I still am pretty. I don't want to say angry, but I'm pretty annoyed. And I know when it comes to trading and investing, blah blah blah, Riz, you say yourself, don't be emotional, don't have emotions, blah blah blah. But for those that know and have taken the master classes, know that we're gonna have emotions. It's about channeling it correctly. I usually channel my emotions in such a way that, and elite members know this well, especially the OG members, where I sometimes trade the best when I'm more in an aggressive stance, so to speak. And I'm not saying it's for other people. People should do that. They should trade angry or something. I'm not saying I'm doing that, but I feel like when I have that kind of fire underneath the seat, I trade better. It's not a sustainable way for anyone. Don't end up having like a fight with your wife or your girlfriend or boyfriend, and then feel like, yeah, I'm gonna go trade now. No, I'm not saying to do that. But just something I personally feel like I operate a little bit better under more duress, more pressure, but within limits. So yeah, I'm not at all very pleased with what occurred on Thursday and Friday. But hey, that's the market. I'm not in control of it. I'm not in control of the Fed speakers. We know when they're going to speak. And Jazz, one of our team members, who's also in here in the chat here, glad to have you on, Jazz. But he provides a fantastic, a more succinct breakdown of what's to come from a event standpoint, but even more detailed than what we show Chris in here. Whether it's a rate hike or a rate decision, whether it's CPI numbers, Jazz shares that in a bit more detail and a whole list. And in that list, it will show specific speakers and dates and time. So we knew Bostic was speaking this week, but what we don't know, and no one knows, is what he's going to say, right? So this is the crucial aspect of markets that no amount of technical analysis, no amount of fundamental analysis, no amount of indicators, no amount of any of your social media gurus telling you to buy calls or puts is going to make any difference, because we're all in the unknown. And this is people, I would say, need to be more aware of that you could see that yeah, sure, we're in a downtrend. We're holding that 50 and 100-day moving average, 200-day moving average right there, and you could say, yeah, look, it bounced up that. But really, who's to say it would not have gone lower if Bostic didn't open his yap, right? So you see what I'm saying? Like, these indicators, every indicator is helpful. It can be helpful, at least a select few, but by no means can you just make a complete, I would say, decision solely on them. And I've been saying this many times, many years now. You cannot place a trade solely on any indicator, and this is a key aspect. I know you can look back and say, well, Riz is a perfect bounce of the 200-day moving average. It is, but you have to more importantly ask yourself, why did it bounce? I feel like that's more important than just saying, oh, the technicals are respect, it moved up, bounced off to 200. Yeah, we know that, we can all see that, but why? And it's important to know that, right? So a little bit of context. No technical precedence for this rally. I know some people will come in and say, well, Riz, we're in an uptrend and this is just a little, dip buying into the further uptrend. And sure, maybe they're right, maybe they're wrong. But I prefer to take things week by week, month by month, as opposed to making a broader call for anything further. I did anticipate a 3,900 level, which is relatively close. We got there, very close to that. We were at 3,923 or something at some point. So yeah, again, just to simplify it for you, very much so, Fed speakers can impact price action and market fear, or on the flip side, like we saw here, euphoria.
I think that's a really great point to kind of hammer home. Is there's so many indicators you can look at, and everybody likes to think that they've got the magic special sauce, and really there are so many different things that affect the way the market moves. And like we're talking about here, these Fed speakers just kind of getting out there, flapping their jaw, and the market goes one direction or another. It's really kind of crazy. What has been, transpired, especially over these last couple of years with these Fed speaker discussions, coming up, really affecting the market, where in the past it was a bit more muted, at least from my memory, and really has kind of thrown a wrench into a lot of things. It makes it really difficult to trade right now.
Absolutely. It's very difficult. And I've been saying that this is a relatively choppy consolidating market. And right now it may not seem like it, but on a day-to-day basis, it's pretty choppy. It's wild. Like, even if you zoom in, Chris, for the past week, if you look at the candles there, even the red candles, right? Thursday and Friday, clearly bullish. But if you take a look at the red candles there, look at the wicks, right? When you're looking at this now, you're like, oh yeah, okay, this is bearish. But when you're actually looking at price action during the day, throughout the day, it's brutal. Like, it's flipping up and down. It's going crazy, right? It's crazy from a live standpoint, and it's not very confidence inspiring when you see those 3, 4, 6, 7 red candles, and then you see this massive 2-day push up, right? Yeah, we know why, because Bostic, but it's not very confidence inspiring from a technical standpoint, where like everything from a technical standpoint, from a supply and demand standpoint, can get thrown out the window, right? And it's very choppy, very challenging.
Yeah, and I think that's really the tricky part right now. I know a lot of people, are having a tough time, and we're definitely, not immune to that. No one is, and it's one of those things where we need to, really just kind of keep an eye on things day to day, like Riz was talking about it, taking it, one day at a time. It's really important in a market like this when you have so much intraday volatility, and you kind of see that with, like what Riz is talking about, with all these wicks here. I think this candle was incredibly green at one point before it pulled back. So there's a lot, going on in the markets these days, and it's definitely something that's very tricky to predict. And anybody who says they can is full of it. And none of us here, myself or Riz included, are going to tell you exactly how the market's going to behave, especially when you have wild moves like this off of just a speaker talking. All right, let's go ahead and take a look here at the breakdown of the S&P 500 to kind of get an idea of what's going on. We finally have enough data points where I feel like we can look at the year-to-date picture so far and get an idea of where we're at. And, as last year, the S&P 500 was down the entire time. Now, from the beginning of the year, the S&P 500 is actually up 5% from where we started. Now, that's not exactly a massive move or anything like that, but it definitely is a bit of a trend break from what we saw last year. And those, areas that are overperforming right now, we've got, communications, tech, we've got consumer discretionary all outperforming the S&P 500, while we do have some that are lagging a little bit. Primarily consumer staples is still down. Healthcare, utilities, all down below the zero line, while real estate, financials, and energy are just kind of hugging right below, but still positive on the year. So, this would suggest that the markets are looking great, right? But obviously, there's a lot of downward negative sentiment going on. Riz, kind of what's your take on this? As far as what's going on in the market.
Yes, and I touched on this last week as well, Chris, and I too brought this to year to date, and I actually brought it to year to date, and then I also did the 1 year. But keeping with the year to date right now, you could see pretty much everything besides consumer staples, healthcare, and utilities is green. So far we've been in a recovery first. We're in third month now of 2023, and so we're in a recovery, right, from a price standpoint in the indexes and different sectors besides the three I mentioned. So that's good. That's a good short-term uptrend. Does this mean that this is going to continue and we'll be back to all-time highs? Hell no, absolutely not. We've seen recoveries happen during and throughout this bear market of starting 2022 January and to now. We've seen these mini rallies. So by no means am I confident enough, nor am I would it be prudent or responsible to call a clear direction of either a bear market continuation or a bull market. I mostly look at it from a key level standpoint, 3,900 being one on the SPX, as I mentioned earlier. And for me, that's the way I look at it. That's the way I approach it. If I see this, Thursday and Friday's run up continue, then I'll reevaluate. And what I'll say is, okay, we have this range, this band between, maybe it's the 4,100. Yeah, thanks, Chris, for pulling out. So 40, maybe it's 4,050 to 4,100. We have that range we may operate in, with 4,200 being that resistance. So these are the kind of ways that I want you and everyone, not Chris, but everyone else watching this, either live or after the fact, to look at markets. Not from a crash, rocket to the moon, and that's it. Life is more nuanced. Markets are more nuanced. Not everything is just a crash and bubble, right? Or going to the moon or going to hell, right? So important to define that, and that's how I look at it. So from a probability standpoint, I want to see how Monday's price action is. I know I sound like a broken record. I always say Monday is gonna define how I operate for the remainder of the week. Can we have situations like this where someone says something or some data comes out and it completely reverses or changes it up? Absolutely. But more often than not, I'm pretty good at being able to have these key levels in the market that I find that eventually the market does trend to. I'm very, very confident that if it weren't for Bostic, I'm sure we would have seen 3,900. I'm confident in saying that. And I had been saying it. So it's just that Bostic came in and, we just had this fuckery occur. But, it's going to happen. It's not the first and it won't be the last time something like this happens.
Yeah, and we'll cover some more of those important dates here coming up in the market because I think we got some more Fed chairs talking. So we'll talk about that in a minute. But let's take a look here at some commodities now. Oil really not doing too much over the last about 3-4 months, honestly, since about November. Really have not seen a lot of movement in oil. I mean, of course, we're seeing ups and downs and rallies and some pullbacks, but nothing too exciting. Oil seems pretty range bound at this point, really having a bit of resistance here, right around 80 or so. Whereas gold had a massive push here, coming in the back part of last year, and then this major pullback since about the beginning of February, that we do seem to be rallying a bit with the market. Now, Riz, is there anything really looking decent in oil? I know in the past we've traded oil quite a bit. Now, of course, we're not suggesting you take any trades, but what are your thoughts on oil here? It just is not really going anywhere.
Yeah, consolidation 101, right? You can see that perfect kind of band between 80 and like 75, 74. And it's it's pretty much safe to say that as long as this consolidation continues, it's not optimal to trade. I don't like trading between these kinds of very narrow bands, and that's just me, of course, but that's my personal view. I like to have somewhat of a more clear direction, as Chris is, nicely drawing those kinds of trend line or channel support and resistance area for us. I feel like right now oil is not really key or right for a trade. It's not uncommon for oil or any commodity really to trade in certain cycles. So, there's going to be months and months where nothing happens. And then you have months and months where it's just trending and just running and running. We've seen that with oil. We've seen that with gold. We've seen that with different commodities. So it's more in the pick and choose, and be very, very mindful of your entries, especially in commodities, because when they trend, they can really trend. And when they consolidate, they can consolidate for quite some time.
Yeah, I mean, obviously we see some trends going on, especially around different times of the year, so like in the summer season, typically we see oil kind of move more towards the upside because people are traveling more. And of course, after that big thing that happened in 2020, when things started to, open back up, there was a lot of, increase in, travel and that sort of thing. But yeah, really just a lot of consolidation in oil here for pretty much the entire winter so far. So just be aware of that as you're going. That, of course, doesn't necessarily reflect the price at the pump, but it does have some correlation. Now, let's take a look here at the bond yields because we've been having a major run up here in the bond yields, especially the 2-year, really kind of making a big move coming upwards here of about 4.9%. That's a pretty big run up on the 2-year bond yields, while the 30 and the 10 are kind of a little bit lower, sitting right around that 4% area. Riz is as inflation continues to go up, and we keep hearing about rate increases and things like that. Should we expect the bond yields to continue like this, or are we going to start leveling out here?
Yeah, I think we're going to start leveling out. I don't think we're going to see bond yields go to like 5.5 or 6 to 2-year at least. I don't see that happening because if that happens, holy crap, uh, it's going to melt down. If it happens really fast, all of a sudden it's going to melt down the system because what happened just in the last month from 2-year yield going from just about 4 to nearly 5. That's a fast move. That's a big move. This is not a commodity. This is not a stock. This is not GameStop. That's a big move for yields, right? In a span of approximately a month for 2-year yield. That's a big move. And nearly 1%, 4%, if you think about it, that's 25% increase in yields the last month or so. So this is a direct impact on short-term credit facilities, even long-term credit facilities, right? We've seen 10, 20, 10, 30, and the 2-year all move up, but the 2-year being the highest tells us that, the market is again very much signaling that we are in for some economic turbulence, which I'm sure, as you already know, isn't. You don't need to be Nostradamus to see that on the horizon, but the market is very much signaling that. For now, the market is signaling a little bit more of a risk-off mode, even though we see these big kind of rallies from week to week in the market, right? So there is supposed to be a bit of a inverse correlation in some of these asset classes, but not always. And in this case, we saw 2-year run up as the U.S. market was coming down. Even when we look at the last 2 days, the 2-year yields are holding up pretty strongly. And I can tell you, mortgage rates went back to 7% in the U.S. Okay, 7% mortgage rates. We're looking at credit card rates around 22, 24% annualized. We're looking at people's savings rates get decimated. We're looking at people's, and Jazz posted this earlier, a great stat, and I'm just going to bring it up here, just and read it here. And he shared this. He said, we're looking at the average American spending a record 46% of their income on house payments, whether that's mortgage or rent. That is like unreal. Like, that's bonkers, right? And if you look at it, and they also said, record 36% of Americans have more credit card debt than savings. Think about that. You look at 3 people. Again, this is an average. You look at 3 people in the street, one out of those 3 is going to have more credit card debt than savings. Okay, that's what we're looking at. You look at 2 people, 1 out of 2, maybe it's you. Is spending nearly half their income just on their household for rent or mortgage. Not talking about groceries, not talking about gas, not talking about healthcare. No, just talking about the actual cost of the house or a condo or whatever, whether it's a mortgage or rent. Just that, nearly 50%. That is unsustainable. Okay, unsustainable. And something's got to give. But if you look at the market, and we just touched on this in the last slide where we showed, not the last one, but the one previous to that, we showed the year to date, and the markets are up this year, 5%. The SPX up 5%. Some sectors like, tech, and you got consumer discretionary up nearly 14%. So you look at, it's at odds. The market is often at odds with what's actually going on from a macro standpoint, but you cannot fight the market. You cannot dictate your views and your thesis on the market. You can do your best to go along with it, have a contrarian view or go along with the trend, but you can't dictate it. You can't override it. You can't supersede what the market's going to do because it's a collective. It's really a collective of millions and millions of different participants. So we cannot individually make a dent on that. All we can do is just try and anticipate it, probabilities, manage our risk. And it's very interesting that the economy is signaling one thing, bonds are signaling one thing, but then you have stocks, equities, risk assets trending upwards, from year to date, the first 3 months nearly. So it's tricky. It's very tricky when I say that doing this and trying to decipher markets is one of the most challenging, also sometimes the most rewarding, but one of the most challenging things I've ever done in life. And for better or worse, I've had to do a lot of difficult things, go through a lot of difficult things in life, but this is one of the most challenging ones. Of course, it can also be very rewarding if you can do it right and get it right. But by no means is this easy. No matter what anyone makes it sound like online, boy, is it not easy.
Man, you're not kidding. And Riz, there's 2 of us here on speaker, so that means that someone else in webinar, someone else nearby is that third person. So we got to keep an eye out for that because I don't think it's you and I don't think it's me, but I could be wrong. But yeah, you're absolutely right on that, Riz. There is a lot of difficult things to be tracking as of late and to kind of get ahead of the market. And I think you really hit on an important thing there is not fighting the market, not going against the flow just for the sake of going against the flow, unless you have a really good thesis behind it for why you want to take that position. It's a real good way to let the market steamroll you. And not that that's ever happened to you or me, of course. But let's take a look at, I promised some important dates coming up, and it looks like someone else is going to be flapping their jaw this week, and that would be on Tuesday. Powell, it looks like he's going to be talking. So this looks like it's going to be kind of an important day in the market, and we've got a lot of important things coming up here. It looks like Powell's talking on Tuesday and Wednesday, and then we've got unemployment on Friday, so definitely some big reporting economic indicators coming up here pretty soon.
Yeah, that's big. That's big. Non-farm payrolls and unemployment is going to be big. Jobs reports also, it's going to be interesting to see, but that's coming in at 10 a.m., half an hour after market opening. And of course, Powell on Tuesday and Wednesday doing testimony, testifying to God knows what. But yeah, there we have it.
Definitely some things to keep an eye on. And of course, now if you're here on our live webinar, would love to have you go ahead and post some questions for Riz and myself. We'd love to, kind of get understand what you guys are looking at, what you want us to take a peek at. Maybe something is on your radar. I know we had some questions come in earlier that Riz answered for some specific elite trades that I'm not going to talk about here on the webinar, because I think that that's really kind of specific to elite. And that's an important thing is, being here live on these webinars, you get the chance to interact with Riz and myself, get that, one-on-one discussion to get your questions answered. Really important. And definitely appreciate each and every one of our members who, takes the time to either come out to these webinars, watch them live or on the replay. And of course, love our YouTube audience. Really like you guys. I wanted to talk about a comment we got on YouTube real quick while some of our people, our elite members here post their questions. And it was hilarious because we were talking about the downtrend in the market, and someone was saying how, I've seen that trend line on 100 different webinars and this, that, and the other. And first off, I have to commend you for watching 100 different YouTube videos about the market. I'm thinking you were kind of exaggerating a little bit, but I want to say that we had this up here considerably earlier than most other people did, and we pretty well nailed this line, to be honest with you, from pretty much right about here in March of last year. So thank you, Mr. YouTube commenter. Really appreciate that. But it's an important thing to keep an eye on, because when we have these major trends going on that seem to be pretty well respected, it's something that you can, get an idea, like what Riz was talking about earlier with different indicators. It gives you an idea of what might happen. Kind of where things may be going. Of course, don't base any trade off of one singular, indicator, but, keep an eye on all of those, because they really can make a difference. All right, Lloyd has a question here on VIX. Let's take a look at VIX. That would be the volatility index. Ooh, boy, volatility indeed. All right, Lloyd says the VIX is below 19. You are absolutely correct. Is this a good time to buy some longer-term protection, or are there better methods that you would recommend? Riz, what are your thoughts?
Yes. So usually, when we see VIX at this level, it's definitely a good idea to consider having some protection in the form of either going long volatility or having some hedges in place, whether you decide to do it from buying puts on the index, or using leveraged ETFs directly, or bearish ETFs, leveraged ETFs directly, or options on them. So there's a few ways you can go about it. Lloyd, in Elite, that I do mention a few of the options, whether I myself, whether if I take a future short as a hedge, or whether I take SPXS calls, or whether I buy SPY puts, or whether I buy SPXS outright. There's a few different ways to go about it, but generally speaking, yes, this is a better time to buy protection, aka insurance, as a hedge, rather than doing it when the VIX is around 30, right? So the adage that you buy the insurance before the storm, not while it's happening or after, right? So this fact is perfectly seen in markets where, if you want to get some protection, you get the protection now at a cheaper premium, at a cheaper price, rather than doing so after the fact, right? Buying tornado insurance when there is a tornado warning it's not the worst thing, but it's definitely not the best thing either. So hopefully this gives you a little bit more insight into what to do, but it's very much up to you what makes most sense for your account, for your style, whether you do it via futures, or whether you do it via options or outright ETFs.
Definitely a lot of different options out there for hedging, as Riz was talking about. One of my personal favorite ETFs, otherwise known as extra small, like I refer to it, which is just the the XPX short ETF, which is a 3x bear ETF, meaning that when that market goes up, this one goes down. So it's basically the inverse of the SPX, but it's 3 times leverage, so it moves 3 times as much. So not something you really want to be holding long term because of numerical decay or mathematical decay. We're not going to go into that in the webinar. It's a bit complicated, and I don't like doing math on screen. That's always an embarrassment waiting to happen.
Yeah, well said.
But yeah, this is one of them, and of course the inverse of that is the SPXL, otherwise known as extra large in my book, or the 3x long or bull ETF for the S&P 500. So these are just a couple of things that you can utilize for your hedges. Again, these are more for short-term holds, again, because of their 3x leverage status. Something that's very important to be aware of before you take something like this, because it can definitely go wrong, and it can go wrong quick if you don't know what you're doing. So definitely a short-term investment as opposed to something swinging. We don't typically swing XL or XS for very long. That's for sure. See, we got some other people typing in some questions here. Kind of while they're doing that, Riz, is there anything that you're watching this week that's, kind of on your radar? Of course, not necessarily that we're going to trade, but things that you're keeping an eye on?
No, the stuff that I kept an eye on, we did take some trades in Elite. I'm not going to mention it here because that's specific to Elite members. I want to keep that for them. But we did make some moves, make some changes. Nothing major, but we did make some changes in our holdings. And as we've continued to see this choppy market, I've been trading less continuously, but that's on purpose, not because I don't want to or I'm not watching. It's mostly a very disciplined, conscious decision, right? And I recommend the same. People need to be a lot more measured, a lot more patient in volatile, choppy markets. And for those that actually watch markets day to day, you'll know what I mean, right? If you're looking at it from a top-down, month-to-month standpoint, you only look at it once a month, you may not understand. But for those that are actively looking at it day to day, seeing the price action, oh boy, it's a doozy, right? So very much recommend holding off on the excess trades or the excess aggressiveness on the trades. I mean, sure, if it works for you, fine, but more often than not, it can end up really denting people's accounts.
No, you're definitely right. And, talking about volatile times, got a question here talking about utilities. And, utilities are kind of taking a beating lately. And he's kind of surprised given the fact that the market is not very stable. What's your thoughts on why that is, Riz? Because, according to Lloyd here, it feels like usually utilities are more of a safe haven investment.
Yeah. So broadly speaking, utilities are lower on the year. So far year to date because we have seen some risk appetite come back, right? We've seen the market positive, and from a a sector rotation standpoint, we can see that. Well, we could see that the SPX when it goes up about a couple percent or 5% in this case year to date, it's not surprising to think that utilities, the money will come out of utilities and go into maybe tech, go into maybe consumer discretionary, right? So that's really what's happening, and that's known as sector rotation, right? So you could see the contrast there between the two charts, where one is kind of languishing sideways, maybe a downward curl, whereas the other one, in this case, tech, very strong leading into the year, right up to now. So not uncommon, not uncommon. Utilities are usually safe havens, but it's not uncommon that we're seeing this happen, even though the market could be on shaky ground.
Oh, here's a favorite one for discussing here. Milton wants to hear our thoughts on Meta. Had a big move Friday given all the AI hype. It's been holding short-term support around 170. Do you think that this is worth a short-term trade? I mean, Meta definitely has been coming back up a little bit as of late. Definitely post earnings, but overall, Meta getting absolutely hammered with all the job cuts, the missed earnings results, and of course, really not doing much. Once this whole Meta first came out, because it was pretty bad. If I'm just going to put it out there, Riz, do you think this is worth a short-term, trade towards the upside, or do you think this is going to really just kind of languish some more?
Personally, not for me. I would have, if it wasn't for Thursday and Fridays, market move. And I know Friday it ran up very strongly, but I'm sure that's also continuation of Thursday as well, with the broader market going up. But I would have chalked this up as a fade lower, if it hadn't been for that momentum. But right now, it's not enough. It's not enough for me to say, okay, you know what? I want to see if I can run this up to 200. I'm not personally seeing that kind of setup. On the flip side, after Friday's move, also not ideal for a short either. Again, personally, from what I'm seeing, I feel like yes, it's holding up that 170 support. If someone feels bullish on uh, Meta, Facebook, their pipeline, Zuckerberg, all that kind of stuff, then yeah, I can't fault them for going long around 170, 175. Um, Even now, I mean, if they really want to go long for a medium term, sure. But for you, Milton, you said for a 1 week or so, uh, you know what? If you do decide to take it on the long side, this would be a trend following trade. So make sure you have a stop in place. Um, but on the short side, no, I wouldn't go out and short it.
Yeah, and I think that's really important when you're taking a trade to really be comfortable with, the type of trade that you're taking and understanding what type of trader you are. Just because it doesn't work for Riz or myself doesn't necessarily mean that it doesn't work for your strategy. And if your strategy works for you, that's the important thing. Yeah, me personally, I'm not touching Meta with a 10-foot pole, but that's just me. And if you like it, if you like the stock and you think it's got the legs to make it to 200, then run with it. It definitely can work. Like Riz said, I have to agree. Keep a stop in place just to be careful, because yeah, this thing can go south quick. So really great question, really great ticker. Really appreciate that. And of course, I think that'll kind of bring us to the end of the webinar here. I want to thank everybody for coming out, especially you, Riz. It's always great to have you on the show and get your opinion of what's going on in the market. We really appreciate it. And if you're not a member at Riz Elite, when we open that back up, you definitely need to make sure you get in on that, because you can be part of these webinars as well and learn from some of the best in the business. Riz has been around for a long time. He's been doing very well for himself, and you can learn from him through Riz Elite. It's a great opportunity.
Yes, thank you. Thank you, Chris, for that. I appreciate that. Yes, it's always great to be on, of course. And as you mentioned, when we do open up, take that opportunity. I feel like what we're doing, the style that we do it in, it's not fast and furious. It's not it's not a casino. It's not the Wild West. That's completely opposite the way we want to operate. But there's definitely a place for people where they can do this. They can do it sustainably. They can do it strategically, and to go alongside whatever else that they may have going on in their life, whether it's a job, career, business, family, whatever. Right? That's the beauty of markets. They can suit you if you know what you're doing and you have the right guidance, the right community. That's the most important thing. And of course, we do quite a bit of heavy lifting for you. Makes life easier. That's not to say you shouldn't do your due diligence and you shouldn't, have some understanding of what you're doing in education and training. But it does make life easier knowing that you have a team in your corner, you have the support system, you have the community, you have access to high quality ideas and setups, and getting that transparency. For me, all bias aside, I can tell you, hand on my heart that it's like nothing else out there, and the value is what my biggest goal is about the value. It's the value proposition, what's given. And to me, I look and I see what's out there. I look and see what we're doing right. If there's something we're doing wrong, if there's something we can improve on. And for those that have been in Elite know this, we're always looking to improve. It's constant improvement, and I believe in that. And we will continue to obviously improve. But where we are, and what we provide, nothing. I mean, I would go as far as to say it's priceless.